Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our November monthly market update. Before I begin, I want to thank our valued clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. So before we start, we want to thank all of the veterans that have served our great country so that we can be free, including my dad, who is an Air Force veteran. This is an easy one. Congratulations to the Houston Astros, World Series champs. It's been quite a fun week in Houston. Also, congratulations to Nola Nair, who just celebrated 10 years with us, serving our valued clients. We want to thank her for serving us, our team, and our clients very well. It was great to see so many of you at our forum recently. We had approximately 100 attend at Perry's over lunch to discuss what's going on in the markets. We also hope to see you here in a few weeks for our curbside event, a client appreciation event with tamales and margaritas. You should have received invitations to that. Please RSVP as soon as possible. We hope to see you there. So a lot going on. I'm going to start with a couple of brand new stories. One involving crypto, FTX. You'll see the Reuters headline below. Is facing voluntary bankruptcy proceedings. So a lot of noise there. How isolated this is to the crypto space remains to be seen, but definitely a noteworthy item. Also noteworthy was the print on inflation, or CPI, on November the 10th. The expectations were a little hotter than the 7.7 number that happened. So when is almost 8% inflation good? And that's when it's expected to be even higher. So the Dow was up 1,200 points, the highest point total since 2020, on a while still hot, a less hot than anticipated inflation number. So there's always a reason to sell stocks. September is a good example in the S&P 500 with the S&P down 9. But then October, the Dow had the best month, up almost 14% since 1976. And where we sit today, as of about a week ago, with the S&P in the 3,800 range. So clearly a lot of volatility. The market's still digesting a lot of different things. We'll kind of unpack a few of those now. I won't speak to the outcome because they're not yet known, but just in terms of what happens on average during midterm elections is that during midterm election years in the fourth quarter, on average, there's kind of there tends to be a reason for markets to go up on average 6.5% compared to presidential election years and non-election years. There's also this data point that since 1942, if you start the time frame, the October before the November elections, every single time with an average of 15%, the markets have been up. So there's kind of some historical, now that sample size is relatively small, but there's general positive movement in the markets in the last quarter of the year in midterm election years. So this is our Fed that continues to be in a tight spot on inflation. This is what the Fed has done thus far this year, with the most recent rate increase being 75 basis points. So their range is now 3.75 to 4. Obviously, inflation is the big news of the week. Again, this was until this week's print where inflation was. We saw possibly peak at 9.1. 8.2 was the most recent reading until this week, where we saw again this number that we've already discussed, where inflation was at 7.7, which was cooler than anticipated. So to the extent that we can call the June an inflation high, which we won't know until the future, but assuming that was peak inflation, this is what has happened in markets when we've been through other peak inflation periods of time. So stocks and bonds the next 12 months, on average, very good for both. Again, if 9.1 was peak inflation. So the economy overall is slowing down, although we did have a preliminary GDP number in Q3 of 2.6 after 2 quarters of contraction, Q1 and Q2. Now, if we do go into a recession, increasingly a recession is predicted for 2023. This is what happens in markets before, during, and then 1 and 3 years after. So what this is telling us is that a lot of what happens in a recession is already priced in by the time you get close to a recession. And then again, much better news 1 and 3 years after the markets or the economy goes through a recession. And this just looks at kind of the average expansion versus recession. Expansion on average is about 5 years, whereas recession on average lasts a little bit over a year. So jobs remain healthy, 261,000 jobs added in the most recent jobs report. Unemployment rate still below 4. Average hourly, it ticked down a little bit. So again, another pretty good jobs report. This is an issue that remains sticky, which is there's 1.8 job openings for every worker that's available. So there remains a shortage of workers overall. And then I'll close with this, just kind of on average, what markets have done since 1926. And I'm going to summarize these numbers here, which is that you have 71 positive years and 25 negative years. The positive years average up 21, the negative years average down negative 13, and the average over the whole period of time is 10.5%. Now, none of these negative years are ever fun to go through. Markets like the one that we're in are clearly nerve-wracking to go through. But again, this is kind of a look at, again, over 3 out of 4 years, markets are up. And when they're up on an average approximately 2 to 1 what they're down over that period of time. So with that, we'll close. None of this commentary is a substitute for talking to you directly about how all of these things impact you. So if you have any questions about this or any changes that we're making or what's going on in the markets, please do not hesitate to call us. That's what we're here for. So please reach out to us. So with that, we'll close. Again, we want to thank our valued clients for the trust and confidence that you place in us. Don't see you before Thanksgiving. We hope you and your families have a safe and a great Thanksgiving, and we hope to see you soon. Take care.